Hi, I'm Darren Wisson, Managing Director of Investor Relations for Invito Energy Partners. Thank you for watching our short educational video series. Today we're going to talk about how to evaluate the economics of oil and gas investing. We'll talk a little bit about how Invito measures up within that. We always like to start with our disclosures, and of course this is not a solicitation to buy a security. That could only be done through a confidential private placement memorandum. Let's jump right into it. Now, I know that the associated tax benefits are the primary headline when it comes to oil and gas investing. It's the driver that gets people interested. But I'd argue that the economic side has to measure up as well. The question I think it's important for investors to ask is, would this investment be worth making if there were no associated tax deduction? If the answer is yes, then you know it's a solid investment that stands on its own, and the deduction accelerates return and helps reduce risk. But if the answer is no, then unfortunately the deduction is carrying the investment, and all you've really done is just invested in a tax shelter. So again, even though the tax deductions are great and fundamental to this sector, it's always important to make sure that there are strong economics that support the underlying investment thesis. Let's do a quick review of some key oil and gas terms, and that'll help you understand where Invito focuses. When it comes to well risk, you could think of this as a spectrum of risk. And on one end is the least risky. We call that developmental drilling. This is where targets are known reserves within existing production data. Type curves are based off offset well performance, and break-even assumptions are very reliable. We call this a tier 1 well. On the other end of the spectrum is exploration drilling, which is where the targets are unproven formations. They have higher potential, but the curves are very speculative, and there's a greater risk of a dry well or total loss from drilling. Break-even assumptions also carry a significant amount of uncertainty. We generally call these tier 3 wells. Of ownership types, there are two. The first is called a royalty interest. A royalty interest owner receives revenue right off the top and bears no drilling cost. They are also not entitled to any of the associated tax deductions. The other ownership type is called a working interest, and a working interest owner bears a proportional share of the drilling and operating costs and receives a proportional share of their revenues after royalties and other overrides. A working interest owner is entitled to all of the associated tax deductions. Of working interest types, there are two. Operated working interest is where the sponsor, the operator, and the drilling company are either owned or controlled by the same entity. You can think of this as being vertically integrated. The other working interest type is called non-operated, and this is a situation in which the sponsor, the operator, and the drilling company are unrelated, working together at arm's length through agreements such as a master services agreement. So when you think about Invito Energy, this is our focus, right? We focus on non-operated, working interest, and tier 1 developmental wells, the wells that have the least amount of risk. Let's talk about the different layers of costs associated with oil and gas investing as they relate to investors. There are three primary categories of costs for investors. The first, of course, are capital costs, and these are costs that come right off the top before any drilling happens. Next, there are revenue-related costs. These are costs that are taken off during production. And the last is upside cost, which is where the sponsor will share in the revenue with the underlying investor. Let's look at each of the individual capital costs. The first is called acreage pricing, and this is the cost per acre to secure those mineral rights. The next capital cost is called the authorization for expenditure, or AFE. These are the budgeted costs to drill and complete each well. Next, we have the organization and offering expenses, often called the O&O. This can be a myriad of different underlying costs, such as legal, administrative, and formation costs, and will typically cost between 5 and 12% of the total capital raised. And last, there are commissions, if any. Some oil and gas opportunities, which are distributed through the broker-dealer channel, will pay a 6 to 8% commission to the advisors as part of the O&O. If you are investing directly with a sponsor or through a registered investment advisor, generally speaking, these commissions are eliminated. When it comes to revenue costs, first you have is that royalty interest, which is the percentage of production income that is paid to the mineral rights owner that comes right off the top. That can generally range between 20 to 25% of total production income. Next, you have the overriding royalty interest, or ORRI, which is carved out of the working interest and is typically used to pay sponsors some level of compensation. This comes off the revenue before investors receive anything. And last, you have asset management fees, if any, which are ongoing fees charged by the sponsor to the fund for the life of the program. Last is, of course, the upside cost. And the most common is carried interest, which is a percentage of the profits that are shared between the sponsor and the investor. And the carried interest can be measured either after a preferred return is met, but more commonly is a percentage of net profits before the investor has received a full return of capital, and then a different percentage of profit after the investor has received their total return of capital. So where does Invito stack up with all of these different costs? When it comes to capital cost, Invito does not charge any markup on the acreage cost. We also charge no markup on AFEs, and we have no commissions embedded in our offering at all. We do have one 10% management fee that's charged one time only on the front end. When it comes to revenue cost, we have no asset management fees embedded in our funds. We do have a 2% ORRI, provided that the minimum NRI is at least 73% or higher on a per well basis. And lastly, when it comes to upside cost, we have no preferred return hurdle, but what we do have is a carried interest that is measured as 4% of the net profits until investors receive a full return of capital, and then we receive 25% of the net profits thereafter. It's important to note that this is calculated on a cash-on-cash basis, so it's exclusive of the tax benefits and inclusive of all the fees that we've talked about. That concludes today's video. Hope you have a good understanding of the different economic terms that drive your total return as an investor. The next step is to schedule your one-on-one fit assessment so you can learn a little bit more about Invito and see if our offering and our fund makes sense given your overall financial goals. I look forward to speaking with you soon. Thank you so much.